Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting. Today is Monday, May 4th, 2020, and continuing along our pattern of the last several weeks during this COVID-19 pandemic, giving you kind of a weekly update on our thoughts, our observations, our analysis, and kind of give you just essentially a brief synopsis of our current thinking. So with that having been said, where we stand right now on the beginning of May is that we had the federal social distancing guidelines basically ended on Friday, and we've got some states that are beginning to open up in a very measured way. Places like Tennessee, South Carolina, Georgia, we'll have to monitor to see if we have any statistical to see what degree the statistical backdrop changes with regard to number of infections and whatnot. Last week, we also got at least some vibes from Gilead Sciences on a therapeutic treatment for COVID-19 patients that actually have the virus. And then we've got obviously a number of protocols that are in various stages of research that could provide us a vaccine. Seems like there's some groundswell of optimism that we might have something by the end of the year, although the traditional timeline for developing a vaccine takes years. And I think there's some smart money on the fact that we may not have something until at some point in the spring next year, but we'll just have to monitor that. But at least from a market standpoint, which we'll dig into first, and then we've got a little bit of political data, I want to spend some time talking about the consumer and some of the observations that we have there, and then kind of finish up with some thoughts on fiscal and monetary policy, basically what the Fed is going to do, and then Congress, what they're looking at right now. But basically, last week in the market, Dow and the S&P were both down slightly. The Russell 2000 was up about 2%. So small caps began to kind of retrace some of that deficit that they built relative to the larger indices. And basically for the month, the Dow was up 11%. The S&P 500 was up about 12.68%. And that was the best month in the stock market since January 1987. And all three indices were up last month about 30% from their March 23rd lows, when the S&P was down about 34%. And a lot of that driven by, I guess, the response mechanism on the part of the Federal Reserve, as well as the government response on fiscal policy and the PPP and the disaster loan program, and then round 2 and round 3 of that, giving a little bit more optimism into the market. So net, from the March 23rd lows, we added about 3.6 trillion in market value last month. And we're up in total market capitalization value about 7 trillion since those March lows. But basically, if we look at the market, we had if we look year to date, though, I mean, obviously we have a lot of optimism kind of exiting last month. But if you look at it year to date, both the Dow and the S&P 500 are down anywhere between like 12.4% for the S&P to about 16, almost 17% for the Dow Jones. Bonds as viewed by the Barclays Aggregate Index are up about 4.9% for the year, whereas both leveraged loans, which are kind of bank loans, if you will, as well as high yield, are both down anywhere between 8 to 9.5%, 8.5 to 9.5%. We did get a little bit of gain in West Texas Intermediate crude. Obviously, we've had some major dislocation in the oil market, but prices were up last week to about $20 a barrel. And just in terms of the economic backdrop, we know that we've got some bad data last week. We were expecting it. It didn't come as a tremendous shock. The total economy, the GDP as it's defined, was down 4.8% for the first quarter. And this is the first reading. We'll get two more readings before it's essentially finalized here in a couple of months. But the first reading of first quarter GDP was negative 4.8%. And that was the worst decline since the fourth quarter of 2008, which happens to coincide with the time of our last recession. And if you look at household consumption, was down about 7.6%, as kind of essential retail purchase items like grocery stores and things like that couldn't offset the big 16% drop that we had in durable goods purchases. On the flip side, business investment was also down about 8.6%. And on both of those sides of the ledger, we expect the numbers to be far worse here in the second quarter. Jobless claims were up about 3.8 million for the week, and that brings a 6-week total to over 30 million new applications for unemployment insurance. And then another key item, two items of data: the ISM, the Institute for Supply Management, their manufacturing index was down to 41.5, which is squarely in contraction territory. And then meanwhile, consumer confidence had a record-setting decline, which again, no surprise, we were expecting bad data, but it dropped down from 118, almost 119, to about 86.9 in April. And probably we'll see that number continue to trend down a little bit. But just in terms of kind of the political backdrop and geopolitical backdrop that we see, clearly in the last week, we've seen increased tensions with China. We know that there's a blame game going on about who started the virus, and China has ramped up its propaganda machine. Where the Commerce Department's making it more difficult for U.S. companies to sell certain technology to Chinese companies, especially those that are linked to military orientation. So we're clearly not going to see some traction on this phase 2 of the trade agreement that we talked about, which seems now so long ago. But we're not even sure how much compliance there is on phase 1. So I can say that there's a really deep fog settling in with regard to U.S.-China relations over COVID that I don't think is going to lift anytime soon. And suffice it to say, we're getting a lot of rhetoric, at least from the administration. I think it's shared by both parties. This animosity towards China right now that I think is going to lead to some incentives for companies to onshore manufacturing back to the States, especially in sensitive areas like pharmaceuticals, where we know that we're disadvantaged and we have to depend on China for those types of things. As much as we, I guess, felt like we had a unified Congress last month, that seems to be transitioning a little bit, because I think what we're heading into is kind of a month of bickering between the sides. So, we've got protests from people and different groups that are, upset with any kind of restrictions at all, that are now protesting, and then we've got kind of a land grab for things that legislators want to put into the next round of stimulus, and just as it were here. So I think we're clearly seeing a little bit of virus fatigue, and I think a little bit of this exuberance that probably isn't warranted as much at this point in time. But we've got new cases that are evolving in areas that previously didn't have much activity. Now we're seeing kind of a transition of new case loads and COVID-19 in the rural areas, whereas some of the more, at least some of the big urban areas are beginning to see that crest and that transition down. But in terms of Congress, we know the Senate's returning this week, and the House is returning to session next week. We've got Republicans that are insisting on lawsuit protection for businesses in this next round. And Republicans are loath to want to consider state and local government aid. Now, the Democrats are very strongly in favor of that kind of aid. In fact, even to the extent that it bails out certain state municipal pensions, which is kind of anathema to the other side. So, yeah, I think that's setting up to become kind of a battle royale, which is not what we need right now, but it's clearly a shift in what we saw last month. But President Trump said that he will not consider a bill that doesn't include a deep payroll tax cut, which Congress is against. Obviously, something like that favors only the people that have jobs, but it also creates an even deeper hole for us with regard to Social Security. So clearly, we've got some, we're at the confluence of a lot of political bickering. We don't think that we're going to see another package for a little while as some of this gets reconciled out. And I'm not even sure that we'll see a bailout program for the states until perhaps even this summer. But meanwhile, the Federal Reserve has continued to backstop and say that they're really ready, willing, and able to step in and keep their foot on the gas pedal, in the face of this political gridlock. In turn, polls show overwhelming support for going slow and easing the lockdown. Public is leery about going to malls and restaurants, but there's probably about 25%, at least according to Greg Valliere, that he thinks they're abandoning social distancing altogether and ignoring advice. But again, his point is you can't force the public to comply with restrictions, so we'll just have to deal with more cases and unfortunately more fatalities, maybe ebbing this summer and then coming back a little bit in the fall, kind of playing into that round 2 theme. But in any case, looking at the consumer, I've got some notes here that, frankly, the average unemployed person is making more than he or she made while they were employed, and especially those that are making below $62,400 are making more while unemployed. So that creates almost a moral dilemma here, in trying to incentivize people to get back to work, or at least employers to get back to hiring. But U.S. savings rate as a result of this has increased to the highest percentage in 39 years. So you think about people saving, they're not necessarily spending. And so I've got some thoughts on that in a little bit, but if you're not spending, then that can lead to kind of a cascade effect in terms of dampening economic growth looking forward. 50% of Americans say that their financial condition is getting worse. Meanwhile, in 2008, that number was 49%. And I mentioned the savings rate, and then 50% of firms think it will take 6 months or longer for demand to return to normal levels. And if you think about that, that's going to have implications with regard to their appetite for hiring. So we certainly need to monitor that. But if you look at consumer spending, which we know dropped 7.5% in March, and we know that that's going to be worse in April. That's the biggest 1-month drop since the government started tracking this back in 1959. 70% of this $21 to $22 trillion economy, at least before COVID, is tied up in consumer spendings. Consumers, they're on the front line, and they're going to have to carry us out because there's just too much that depends on this. And I think the key takeaway with regard to consumers is that people have strained budgets. We know that 30 million plus people have lost their jobs in the last 6 weeks. And we've got, as I mentioned, large U.S. employers that have disclosed lots of furloughs and voluntary leaves and things like that. Americans, more than half of U.S. households don't have any emergency savings to tap into a crisis, and even a quarter of households earning greater than $150,000 have one. We're seeing anecdotally from American Express, who's tripled its credit loss provisions, that people aren't paying their credit card payments. We know that there's lots of forbearances being issued by banks on mortgages. It's a couple of interesting comments that'll be interspersed through here. One is people over the age of 65 represent about 20% of total consumer spending. And just think about, that cohort that's not going to be motivated to want to get out because they're an at-risk population. And if anybody's going to be reticent to want to get out and spend, it might be this group. So we're really going to have to monitor that. Just credit card spending was down about 34% in that week ended April 12th, which is the last week that we have available for data. And the debit card spending was down about 15%. And then if you even look before that, just before the stay-at-home order was given, those two things were down quite a bit. So we've got consumers that are, kind of looking at this. I think the best guess that I have at this point is that coming out of this, we're going to have a shift in preferences. Already, we're seeing kind of a penchant towards consumers that want to maybe shop more thrifty. They want to shop at Walmart instead of a more upscale, or they're looking at house brands instead of the branded items. And I think that's going to be a trend. And I look at it with my behavioral finance hat on too. And something like this, it imposes an emotional anchor, or not an anchor, but it changes your DNA. Something of this magnitude has a chance of changing the DNA about how the consumer views the world. And we know that getting back in a phased way is going to take companies that are willing to almost bear lost leaders to get people in the door. Because if you're thinking about reducing seating capacity in restaurants and theaters, so they're going to be operating at a loss, but they have to do that to inspire more consumers to come out. The airline industry, which is already in a bailout program, they're going to be flying less than full planes, and think about things like that. And so companies are going to have to be willing to take on, in some cases, a lost leader just to get more enthusiasm from the consumer. And the consumer themselves are going to be wired to hold back more seed corn, to save more. And we already see the savings numbers begin to transition. Companies are going to be hoarding cash. Consumers are going to be hoarding cash. And so it's something that's going to, I think, create more of that, the so-called V-shaped recovery versus the U-shaped recovery. And I think it's going to lend itself more to the latter. In fact, some people even call it kind of a Nike swoosh, where we've gone down, and it's just going to take us a while because we've got mental components that the consumer is wrestling with. We have some very tangible shifts in savings versus consumption that's taking place, and I think it's going to take a while for us to get back and kind of break this what's being called a demand doom loop, which is you have furloughs and layoffs, which drives people to reduce their spending. And then that helps to lead to an economic slowdown. And then that leads to more furloughs and layoffs. And then so the cycle repeats itself until you can break that and you can build confidence in things that people can spend, they can invest, and so on and so forth. But having said that, the good news is that the household is in the best shape overall that we could have been in going into this. If you look at 2006, 2007, the household debt as a percent of GDP was 99%. And going into this, it was 76 here a couple of months ago. Savings rate the last few years was already fairly high, despite all of the drive and consumption. But the savings rate back in 2006-07 was very, very low. But again, we have this layer of uncertainty right now. We don't know, we don't know what things are going to look like by June. We've got a feeling. We hear from doctors, we hear from experts, virologists that have opinions on things, but we don't really know. And so there's a caution flag that's being held by the spending public, not the investments. So investing public is different from the spending public, but we're going to have we have some speculation. We have some thoughts that things are going to be better, but we just need to see it play out and have a little bit more definitive data before I think you'll see consumers really begin to react to that. But as I mentioned, probably expect consumers to hold a little bit more cash coming out of this. And like I said before, I think it's going to clearly impact, I think, purchasing patterns. Again, people that might be inclined to buy certain types of products may switch. May switch to competing products that are less expensive, and people might become more thrifty. So I think we'll just have to watch that. And just something I thought I'd bring up today as a talking point. But I think just in terms of unemployment, as we're watching that data and how it kind of translates into consumer behavior. Unemployment typically is a lagging indicator. This is something very interesting. Now it's leading now because we've had this forced shutdown, but you usually see unemployment peak after the recession is actually over. And in this case, we're seeing it all front loaded. We've seen obviously the restaurant industry, which is 4% of the economy, clearly devastated. So we've got probably about another 12 to 13 to 14% spike in unemployment coming. And the way that I've kind of done some reading over the weekend that kind of breaks out that we get about 4 percentage points of incremental unemployment from leisure and hospitality, another 3 to 3.5 from retail, and then smaller amounts from transportation, construction, manufacturing, and then a litany of other smaller impacts. But if you think about the unemployment rate spiking and the number of jobs that are being lost, a lot of them are predictably focused in the leisure, hospitality, retail areas, and lesser degree transportation, which are not necessarily the highest paying jobs, but it's impacting the people that need the most help. So something that I think we ought to consider, or at least follow. But with regard to the fiscal and monetary policy, just a few comments before we conclude here. Obviously, we've seen the most aggressive monetary and fiscal policy stimulus programs that we've had in post-war peacetime conditions, and the Federal Reserve has increased its own balance sheet by more than 50% to almost $7 trillion, and it's probably going to go higher. We've got rates to zero. The Fed last week said that they're prepared to leave them there for a very extended time. So you think about that from a standpoint of savers. Savers that depend on a rate of earning on their investments are going to be challenged in that regard because rates are going to stay very, very low for a while. But the Fed has really backstopped everything, and the infusion of liquidity actually should weaken the dollar. So a weaker dollar is good for commodities. It's actually good in terms of trade, even though we know global trade has been severely curtailed. And it also helps emerging markets. So we think about that in terms of our investment selections. So you look at our federal deficit, still tracking closer to 3.8 trillion. I mentioned the Fed's balance sheet, but the good news is that as a percent of GDP, the Federal Reserve's balance sheet is smaller than both the European Central Bank as well as the Bank of Japan. So I think some might view that as there being more room to go in terms of the Fed trying to get in there while we've got this political skullduggery going on in Washington. So, but those are some of the high points. I spent probably a little bit more time on the consumer this time because we're getting some really good data on what's happening there now, and we know it's apt to get a little bit worse here in April when some of the monthly data comes out in a few weeks, and we know that companies are out there pulling their guidance. They're cutting their dividends. They're trying to preserve liquidity. We're watching all of that, but there is a lot of liquidity that's going to find its way to the market, and it's going to find its way probably before this ends. We just need a little bit more visibility and tangible data points that kind of points to that turning point, if you will, on caseloads, rhetoric regarding the pursuit of a vaccine, those types of things. And I could see where, even though the market is not cheap at all, that there would be more enthusiasm for investment. But in any case, that's about it for now. And I'm going to start perhaps a little series on kind of chart of the week. There's a couple of things that really stuck out to me, and so we'll have a separate thread on that. And as always, appreciate your thoughts, comments, and feedback. Urge you to reach out to us if you have any questions. You can reach us at www.bkawealth.com or www.bkawealth.com, or you can reach us at 512-522-4838. Hope you've enjoyed this and look forward to seeing you again, perhaps next week. Thank you.